I've spent my entire career studying debt cycles. Not because I find them academically interesting, but because understanding how debt works is the single most important skill for protecting and growing wealth. In 1982, I learned this lesson the hard way. I predicted a depression that never came, and I lost everything. I had to borrow $4,000 from my dad just to pay my bills. That failure forced me to go back and study every major debt crisis in history. The Great Depression of the 1930s, the Latin American debt crisis of the 1980s, the Asian financial crisis of 1997, the 2008 global financial crisis. And through that study, I discovered something profound. Debt crises follow patterns. They're not random. They're not unpredictable. They happen in cycles. And if you understand the mechanics of how these cycles work, you can not only protect yourself, but actually profit during the most challenging times. I wrote an entire book on this, Principles for Navigating Big Debt Crises, where I analyzed 48 different debt crises going back 100 years. And what I found is that they all have the same basic structure, the same phases, the same warning signs, and most importantly, the same investment opportunities. Now, here we are at the end of 2025, heading into 2026, and I'm seeing all the warning signs again. U.S. government debt is over $36 trillion, more than 120% of GDP. Interest payments on that debt now exceed our defense spending. We're in the late stages of a long-term debt cycle that began after World War II, and the end game is approaching. But here's what most people don't understand. A debt crisis isn't something that happens overnight. It's not like one day everything's fine and the next day the world is ending. It unfolds over months and years. They're distinct phases. And if you understand which phase we're in and what comes next, you can position your portfolio accordingly. That's what I want to teach you today. Not theory, not academic concepts. A practical, step-by-step guide for how to invest during a debt crisis. The exact framework I use at Bridgewater, the same framework that allowed us to make money in 2008 when most hedge funds were getting crushed. This isn't about predicting the exact day the crisis hits. It's about understanding the machine, seeing where we are in the cycle, and taking the right actions at the right time. Let's dive in. Before we get to the step-by-step guide, you need to understand how debt cycles work. Because if you don't understand a machine, you can't navigate it effectively. Every debt cycle, whether it's personal debt, corporate debt, or government debt, goes through 4 distinct phases. And each phase requires a different investment strategy. Phase 1, the early cycle, debt growing, economy growing. This is the good times. The economy is growing. People are optimistic. Borrowing is easy and cheap. Interest rates are low. Asset prices are rising. Everyone feels rich. In this phase, debt is growing faster than incomes, but that's okay because the economy is growing too. People can service their debt. Businesses are profitable. Tax revenues are increasing. Everything seems sustainable. This is where we were from 2010 to 2019. After the 2008 crisis, central banks cut interest rates to zero, printed money, and triggered a decade-long expansion. Stocks went up. Real estate went up. People felt wealthy again. In phase 1, the right investment strategy is simple. Own growth assets. Stocks, real estate, high-yield bonds. Take some leverage if you want. The rising tide is lifting all boats. Phase 2, the bubble, debt too high, warning signs emerging. But eventually, debt grows too much relative to incomes. People are borrowing more and more just to maintain their lifestyle. Companies are taking on debt not to grow, but to buy back stocks and pay dividends. Governments are running massive deficits even when the economy is strong. Asset prices get disconnected from fundamentals. Valuations get stretched. Price-to-earnings ratios on stocks are at historic highs. Real estate prices are at records. People are paying absurd amounts for assets because they assume prices will keep going up forever. This is when smart money starts getting cautious. The warning signs are there if you know what to look for. Inverted yield curves, tightening credit conditions, slowing economic growth despite low interest rates, wealth inequality hitting extremes, political polarization increasing. We saw this in 2006 to 2007 before the 2008 crisis. We saw it in 1928 to 1929 before the Great Depression. And we're seeing elements of it now. In phase two, the right strategy is start de-risking, reduce leverage, take profits on expensive assets, build cash positions, add defensive assets like bonds and gold. Don't be the last person at the party. Phase three, the crisis, debt burden too high, deleveraging begins. Eventually, something triggers a loss of confidence. Maybe it's a default, a government, a bank, a major corporation can't pay its debts. Maybe it's inflation that forces central banks to raise interest rates aggressively. Maybe it's a geopolitical event. Whatever the trigger, suddenly everyone realizes at the same time that there's too much debt and it can't be serviced. Credit markets freeze. Asset prices collapse. Everyone tries to sell at the same time. Panic sets in. This is 2008. This is 1930 to 1932. This is when wealth gets destroyed on a massive scale. Stocks fall 30%, 40%, 50%. Real estate collapses. Companies go bankrupt. Banks fail. Unemployment spikes. In phase three, the right strategy is capital preservation and selective opportunism. Hold cash and safe government bonds. Let others panic sell. Wait for assets to get truly cheap. Then, when there's blood in the streets, when everyone is terrified, that's when you start buying. Phase four, the recovery, deleveraging, restructuring, reflation. After the crisis, governments and central banks respond. They cut interest rates to zero or negative. They print money, quantitative easing. They bail out banks. They run massive fiscal deficits. They do whatever it takes to stop the collapse and restart growth. Debt gets restructured. Some gets defaulted on. Most gets inflated away through money printing. Slowly, painfully, the economy begins to recover. Asset prices bottom and start rising again. The cycle begins anew. This was 2009 to 2010. This was 1933 to 1934. This is when fortunes are made by those who position themselves correctly during the crisis. In phase four, the right strategy is aggressive redeployment. Buy quality assets at bargain prices. Take calculated risks. Use the printed money and low interest rates to your advantage. Position for the next expansion. Now, here's the key question. Where are we now? I believe we're somewhere between phase two and phase three. The bubble phase is mature. The warning signs are flashing. The trigger could come anytime, or it could be another year or two away. But the direction is clear. And that means we need to position ourselves accordingly. All right, let's get practical. Step one in navigating a debt crisis is to assess your current situation honestly and completely. Most people skip this step. They want to jump straight to what should I buy? But you can't make good decisions about where to go until you know where you are. Here's what you need to do. First, calculate your total exposure to risky assets. Sit down with your brokerage statements, your retirement accounts, your real estate holdings, everything. Add up how much you have in stocks, public equities, real estate, your home, investment properties, high-yield bonds, junk bonds, corporate debt, private equity or venture capital, cryptocurrencies, any other growth-oriented or speculative assets. These are your risk assets. These are the things that will fall significantly if we go into phase three, the crisis phase. Now calculate what percentage of your total net worth is in these risk assets. If you have $1 million in total wealth and $800,000 is in stocks and real estate, you're 80% exposed to risk assets. That's dangerously high if a crisis is coming. Second, assess your liquidity. How much cash or near cash do you have? Money market funds, short-term treasury bills, savings accounts, liquid assets you can access immediately without selling something at a loss. In a debt crisis, liquidity is king. Cash is king. Because when asset prices are falling and credit markets are frozen, the ability to act, to meet obligations, to take advantage of opportunities, that's what separates those who survive from those who get crushed. At Bridgewater, we always maintain significant liquidity even in good times. Because we know that opportunities appear when you have cash and others don't. I recommend having at least 10 to 20% of your portfolio in liquid, safe assets. If you're older or more risk-averse, 20 to 30%. This is your shock absorber, your dry powder, your optionality. Third, evaluate your income stability. How secure is your income? If you're employed, how recession-proof is your industry? If you're a business owner, how would a severe recession affect your revenue? If you're retired, how much of your income depends on investment returns versus guaranteed sources like Social Security or pensions? This matters because your income stability determines how much portfolio risk you can afford to take. If your job is secure and your income is stable, you can take more portfolio risk because you have time to recover. But if your income is vulnerable, you need a more defensive portfolio because you might need to draw on your savings during the worst possible time. Fourth, understand your debt situation. How much debt do you have? Mortgages, car loans, credit cards, student loans, business debt? What are the interest rates? Are they fixed or variable? What are the monthly payments relative to your income? In a debt crisis, your own debt becomes either a millstone or a tool, depending on how it's structured. Fixed rate debt at low interest rates? That's actually good. You locked in cheap money. Variable rate debt or debt coming due soon? That's dangerous. The goal is to go into a crisis with as little short-term, high-interest debt as possible. Pay down credit cards. Refinance if you can lock in low fixed rates. Extend maturities. Reduce your vulnerability. Fifth, consider your time horizon. How many years until you need this money? If you're 30 years old investing for retirement, you have decades. You can ride out a crisis. In fact, a crisis is an opportunity for you to buy assets cheap. But if you're 65 and about to retire, you don't have time to recover from a 50% portfolio decline. You need to be much more defensive. Your time horizon fundamentally determines your strategy. Long time horizon equals you can take more risk and be more opportunistic. Short time horizon equals you need to protect what you have. Take out a spreadsheet. Actually do this exercise. Write down. This is your starting point. This is the truth of where you are. And only once you have this clarity can you make good decisions about where you need to go. Step 2. Rebalance your portfolio to a more defensive posture. If your assessment from Step 1 showed that you're overexposed to risk assets, underliquid, or vulnerable in other ways, you need to adjust. And the time to adjust is now, before the crisis, not during it. Here's how to rebalance defensively. Action 1. Reduce concentration risk. If you have more than 10 to 15% of your portfolio in any single stock, any single sector, or any single geography, that's concentration risk. And concentration risk is what destroys people during crises. I don't care how much you love that stock. I don't care if it's your employer's stock or a company you're emotionally attached to. Diversify. Sell down to a reasonable position size. In 2008, I saw people who had 50%, 60%, 70% of their net worth in their employer's stock. And when those companies collapsed, Lehman Brothers, Bear Stearns, AIG, GM, those people lost everything. Their job and their savings gone simultaneously. Don't let that be you. Diversify broadly across stocks, geographies, sectors, asset classes. Action 2. Increase high-quality bond allocation. Bonds get a bad rap after 2022 when both stocks and bonds fell together. But that's because people were holding the wrong bonds, long-term nominal bonds that got crushed by inflation. What you want now are short to intermediate-term treasury bonds, safe, liquid, stable. Inflation-protected bonds/TIPS, protection against inflation. Investment-grade corporate bonds with short maturities, higher yield, still relatively safe. These bonds won't make you rich, but they'll protect you when stocks fall. In 2008, while stocks fell 50%, treasury bonds actually went up. They provided the ballast that kept portfolios from total destruction. I recommend increasing bond allocation to 30 to 40% of your portfolio if you're not already there. Mix of TIPS and regular treasuries. Action 3. Add gold exposure. Gold is insurance. In a debt crisis, when governments are printing money and devaluing currencies, gold holds its value. In a 1970s debt crisis, gold went from $35 to $850 per ounce. In the 2008 crisis, gold held steady while everything else collapsed, then rallied strongly in the recovery. If you don't already have 5 to 10% in gold, add it now. Through a low-cost gold ETF like GLD or IU. Simple, liquid, effective. Action 4. Build cash reserves. This is critical. Raise cash to at least 10 to 20% of your portfolio. Sell some winners. Trim positions that have run up a lot. Take profits. Yes, cash loses purchasing power to inflation. But in a crisis, cash is the most valuable thing you can have. Because when assets are cheap and everyone else is desperate, cash gives you options. Cash is optionality. Warren Buffett, another legendary investor, keeps billions in cash for exactly this reason. Not because he doesn't know what to do with it, but because he's waiting for the fat pitch, the moment when he can deploy it at extraordinary prices. Action 5. Reduce or eliminate leverage. If you're using margin, if you have borrowed money to invest, pay it down. Now, before the crisis, leverage is a double-edged sword. It amplifies gains in good times, but it amplifies losses in bad times. And in a debt crisis, leverage is what forces people to sell at the worst possible moment. Here's what happens. You have $100,000 of your own money and you borrow $50,000 on margin to buy $150,000 in stocks. Market falls 30%. Now your stocks are worth $105,000, but you still owe $50,000. Your equity is only $55,000. You've lost 45% of your money, even though the market only fell 30%. Worse, your broker issues a margin call. You have to either put in more cash or sell stocks. And you're forced to sell at the bottom, locking in losses. Don't use leverage heading into a crisis. It's not worth the risk. Action 6. Review and adjust real estate exposure. Real estate is tricky in debt crises. It depends on leverage, location, and type. If you own your primary home with a fixed-rate mortgage at a low interest rate, you're probably fine. Don't panic sell your home. But if you have investment properties with high leverage, variable rate mortgages, or properties in overvalued markets, consider whether you want that exposure. Real estate is illiquid. You can't sell it quickly if you need to. At minimum, make sure you have adequate cash reserves to handle 6 to 12 months of expenses if rental income drops or you lose your job. Action 7. Stress test your portfolio. Run scenarios. What happens if stocks fall 40%? What happens if your income drops 30%? What happens if inflation stays at 5% for 5 years? Most brokerage platforms have tools for this, or you can do it manually in a spreadsheet. Take your current allocation, apply a 40% drop to stocks, a 5% drop to bonds, a 30% rise in gold, and see what your total portfolio looks like. If the result is devastating, if you'd lose more than you can afford to lose, you need to rebalance more aggressively. The goal of defensive positioning isn't to avoid all losses. That's impossible. The goal is to survive the crisis with enough capital intact that you can take advantage of opportunities during the recovery. This is what we did at Bridgewater in 2007. We didn't predict the exact timing of the 2008 crisis, but we knew the risks were extreme. So we rebalanced defensively, increased cash and gold, reduced equity exposure. And when the crisis hit, we were positioned to not just survive, but to profit. 1430 to 1845. Step 3. Identify crisis opportunities. All right, Step 3. Identify the opportunities that appear during debt crises. This might sound counterintuitive. The world is falling apart, people are panicking, and I'm talking about opportunities? Yes, because this is when the greatest wealth transfers happen. From those who are unprepared to those who are prepared. Let me be clear, I'm not talking about trying to catch a falling knife. I'm not talking about buying on the way down, hoping you found the bottom. That's how people get crushed. What I'm talking about is understanding what becomes cheap during a crisis and being ready to act when the time is right. Opportunity 1. High-quality stocks at depression prices. In every debt crisis, great companies with strong balance sheets, sustainable business models, competitive advantages, they get thrown out with the trash. In 2008, You could buy McDonald's, Coca-Cola, Johnson, Procter & Gamble, blue chip companies that weren't going anywhere at 40 to 50% discounts. Not because anything was wrong with the companies, but because everyone was panicking and selling everything. In March 2009, Apple was trading at $12 per share, split adjusted. Today, it's over $200. That's a 16x return in 15 years. And that opportunity existed because of panic. Make a list right now of 10 to 15 companies you'd love to own if the price were right. Companies with strong brands and competitive advantages, low debt and strong cash flow, products or services people need in good times and bad, history of surviving previous crises. Then set target prices at which you'd start buying. Typically, that means buying when stocks are trading at PE ratios of 10 to 12, when dividend yields are 4 to 5%, when a market is down 40 to 50% from its highs. Opportunity 2, distressed debt. When companies get into trouble during a crisis, their bonds trade at huge discounts. You could buy corporate bonds for 30 to 50 cents on the dollar. Now, you have to be careful here. Some of those companies will go bankrupt and you'll lose everything. But if you can identify companies that are temporarily distressed but fundamentally viable, you can make extraordinary returns. In 2008 to 2009, I knew investors who bought distressed debt from solid companies like Ford, Goldman Sachs, companies that were struggling but weren't going to disappear. Those bonds, bought at 40 to 60 cents on the dollar, eventually paid out at 100 cents. That's a 40 to 150% return with much less risk than stocks. This is a more advanced strategy. If you're not sophisticated in credit analysis, you can access it through distressed debt mutual funds or ETFs. But the principle is the same: quality assets at crisis prices. Opportunity 3, real estate at capitulation prices. Real estate always gets crushed in debt crises because it's leveraged and illiquid. In 2008 to 2011, home prices in the U.S. fell 30 to 40%. In some markets, 50 to 60%. And that created incredible opportunities. I know people who bought rental properties in 2010 to 2012 at half the cost of construction. They're still collecting rent on those properties today, and the properties have doubled or tripled in value. The key is to wait for capitulation, when sellers are desperate, when foreclosures are peaking, when no one wants to touch real estate. That's when you buy. Not at the first sign of trouble, but after prices have truly crashed. And you need cash to do it. Banks aren't lending during crises. So if you have cash, you have massive advantages. Opportunity 4, commodities after a collapse. Commodities, oil, copper, agricultural products, they often get crushed during the initial crisis phase as demand collapses. Oil went to $35 per barrel in 2008 to 2009. Copper fell 60%. But then, when governments start printing money and running massive deficits to stimulate the economy, commodities come roaring back. Oil went from $35 to $120. Copper doubled. The strategy: wait for commodities to get truly cheap, below the cost of production for extended periods. Then buy, because eventually demand will recover, supply will have been curtailed, and prices will surge. Opportunity 5, emerging markets after stabilization. Emerging markets always get destroyed during global debt crises. Capital flees to safety. Emerging market currencies collapse. Stocks fall 50 to 70%. But these markets also recover strongly once the crisis stabilizes. Because they're growing faster than developed markets, they have younger populations, they're less indebted. In 2008, emerging market stocks fell 60 to 70%. By 2010, they had doubled from the lows. If you bought near the bottom, you made 100% returns in 18 months. The key is not to try to catch the falling knife. Wait for stabilization. Wait for credit markets to thaw. Wait for the initial recovery to begin. Then deploy capital. Now, here's the critical thing about all these opportunities. You can only take advantage of them if you have capital available. If you're fully invested when the crisis hits, if you don't have cash, if you're forced to sell at the bottom, you miss everything. That's why steps 1 and 2, assessing your situation, and rebalancing defensively are so critical. They set you up to be a buyer when everyone else is a forced seller. At Bridgewater, we made a fortune in 2008 to 2009 not because we were smarter than everyone else, but because we were prepared. We had raised cash. We had hedged our positions. And when assets got cheap, we had the capital and the courage to buy. Step 4. Execute your crisis plan with discipline and don't try to time the bottom perfectly. This is where most people fail. They have a plan, they know what they want to buy, but when the moment comes, they freeze. Or they try to be too clever, waiting for the absolute perfect moment that never comes. Here's what you need to understand. You will never buy at the exact bottom. Never. No one does. The bottom is only clear in hindsight. What you can do is buy when assets are significantly cheaper than their intrinsic value, when fear is extreme, when valuations are compelling. Here's how to execute with discipline. Rule 1. Use dollar cost averaging during the crisis. Don't try to deploy all your capital in one shot. That's too much timing risk. Instead, spread your buying over time as the crisis unfolds. For example, let's say you have $100,000 in cash you want to deploy. The market falls 30%. Don't put all $100,000 in. Put in $20,000, 20% of your total. Market falls another 10% to 40% down total. Put in another $25,000. Falls to 50% down. Put in another $30,000, and so on. You're averaging in, building positions as prices get cheaper. This approach ensures you don't run out of money too early, and you get better average prices than if you try to time it perfectly. Rule 2. Buy quality, not junk. In a crisis, everything goes on sale. Both the good stuff and the garbage. Your instinct might be to buy the cheapest, most beaten down stocks because that's where the biggest gains could be. Resist that instinct. Many of those beaten down stocks are beaten down for good reason. They're going to zero. Instead, focus on quality. Companies with strong balance sheets, low debt. Companies with sustainable competitive advantages. Companies in industries that will survive the crisis. Companies with management teams that have navigated crises before. You might not get the biggest percentage gains buying quality, but you dramatically reduce your risk of permanent capital loss. Rule 3. Ignore the noise. During a crisis, the financial media will be screaming at you 24/7. Markets crash to new lows. Worst day since the Great Depression. Investors flee to safety. Ignore it. All of it. The media makes money from fear and excitement, not from helping you make good investment decisions. In fact, I'd recommend during the height of crisis, you stop watching financial news entirely. Check your portfolio once a week at most. Focus on your plan, not on the hourly market movements. Rule 4. Rebalance systematically. As you buy during the crisis, maintain your target allocations. If your plan is 40% stocks, 30% bonds, 20% cash, 10% gold, then as you deploy cash into stocks, make sure you're maintaining those ratios. This forces discipline. It prevents you from getting too aggressive at the wrong time or too conservative at the wrong time. The plan keeps you balanced. Rule 5. Prepare emotionally. This might sound soft, but it's critical. When you're buying during a crisis, it will feel terrible. Everything you buy will go down further before it goes up. You'll question yourself. You'll wonder if you're catching a falling knife. This is normal. Expect it. Embrace it. The best opportunities always feel terrible in the moment. In March 2009, when I was buying stocks, every fiber of my being was screaming, "This is crazy. The world is ending. Why are you buying?" But I knew from studying history that this is exactly when you're supposed to buy. Talk to yourself. Journal. Have a support system, a spouse, a friend, an advisor who understand your plan and can remind you why you're doing what you're doing. Rule 6. Keep dry powder in reserve. Even as you're buying, don't deploy 100% of your cash. Keep 20 to 30% in reserve, because things can always get worse than you expect. Markets can fall further than seems rational. If you have reserve capital, you can take advantage of those extreme moments. If you're fully deployed, you're helpless. At Bridgewater, we always keep dry powder. Always. It's our insurance policy against our own overconfidence. The bottom line, Have a plan, execute the plan. Don't deviate from the plan based on emotions or short-term noise. The plan is what saves you from yourself. All right, let me wrap this up by talking about the 3 biggest mistakes people make during debt crises, and then I'll give you your action plan. Mistake number 1, panicking and selling at the bottom. This is the most common and most devastating mistake. People hold through the initial decline, thinking it's temporary. Then as it gets worse, they start to panic. And finally, at the point of maximum fear, when losses are already huge, they sell everything. This locks in losses and ensures they miss the recovery. In 2008, so many people sold in March 2009, the exact bottom. They took 50 to 60% losses, then watched from the sidelines as the market doubled over the next 2 years. Don't be that person. If you followed steps 1 and 2, if you've positioned defensively, you can ride out the storm. Hold your quality assets. They will recover. Mistake number 2, trying to time it perfectly. The opposite mistake. People who have cash, who are positioned well, but they're waiting for the perfect moment. I'll buy when the S and AMP wink with tongue sticking out hits 2,000. It hits 2,200 and stops. I'll buy when unemployment hits 12%. It only goes to 10%. They're so focused on getting the perfect entry that they miss good entries. And then the recovery starts, and they're still sitting in cash. Don't wait for perfection. Wait for compelling value. If stocks are trading at 10x earnings when the historical average is 15x, that's compelling. You don't need it to be 8x. Mistake number 3, buying too early. The flip side, people see stocks down 20% and think this is the opportunity. They deploy all their cash. Then stocks fall another 30%. They're fully invested at bad prices and have nothing left for the real opportunities. This is why dollar cost averaging is so important. Spread your buying. Be patient. Let the crisis fully unfold before you go all in. Now, here's your action plan for the next 30 days. Week 1, assessment. Complete the Step 1 assessment. Calculate your risk exposure, liquidity, debt situation. Write down your findings. Be brutally honest. Week 2, planning. Decide on your target defensive allocation based on your situation. Make a list of quality assets you'd buy in a crisis. Set target buy prices for those assets. Week 3, rebalancing. Start executing the rebalancing from Step 2. Don't try to do it all in one day. Spread over a couple weeks. Sell some winners. Build cash. Add bonds and gold. Week 4, monitoring. Set up a simple monitoring system. What indicators will you watch? Commit to a review schedule, weekly or monthly, not daily. Share your plan with someone who can hold you accountable. And then wait. Be patient. Watch the indicators. And when the crisis comes, not if, when, you'll be ready. At Bridgewater, we've navigated every major crisis for 50 years using these principles. The mechanics of debt crises haven't changed. The human emotions haven't changed. The opportunities haven't changed. What has changed is that more people now have access to the information and the tools to protect themselves and profit. That includes you. You don't need to be a billionaire or a professional investor. You just need to understand the machine, follow the steps, and execute with discipline. The crisis is coming. The question is, will you be a victim or a beneficiary? Subscribe to this channel for more insights on navigating the debt crisis. And remember, preparation beats prediction every time. Thank you for watching. Now go do the work.